At this very moment, as you view this, the most significant financial reset in human history is being engineered. This isn't happening in concealed backrooms filled with shadowy operatives, but right out in the open. The chess pieces are in motion. The key players have taken their stations. And 2026 marks the year when the paradigm shifts completely. This isn't idle conjecture. This isn't an attempt to monger fear. This is the result of recognizing specific patterns based on documented economic cycles that have been repeating for more than a century. If you fail to grasp what is approaching, you will find yourself on the losing end of the greatest transfer of wealth ever recorded. Allow me to demonstrate exactly what is unfolding, the unseen architecture of wealth extraction. There is a mechanism embedded within our financial system that the vast majority of people never perceive. It functions with clockwork precision. Every 10 to 15 years, it engages. And when it does, wealth streams in a single direction, from the masses to the few, from the middle class to the ultra-elite. It moves from those who are compelled to sell to those who are positioned to buy. This is not a conspiracy theory. It is a matter of historical record. 1987, 2008, 2020. Every major financial crisis adheres to the exact same template, the same 5 phases, the same machinery, the same outcome, and it is occurring again right now. We are currently in the late stages. The final phase before the reset is rapidly approaching. The signs are omnipresent if you know where to focus your attention. Look at the $325 billion warning siren. Warren Buffett is currently holding $325 billion in cash. Let the magnitude of that number sink in. It is the largest capital position ever amassed by any investor in history. This isn't money he intends to spend tomorrow. This is a war chest waiting for the collapse. Over the last 2 years, Buffett has systematically sold over $100 billion in stocks, deliberately converting assets into liquid cash while valuations remain sky high. Why? Because he has executed this play before. In 2006 and 2007, he accumulated cash prior to the 2008 meltdown. When the markets imploded and the world was selling in a panic, he deployed that cash. He bought into Goldman Sachs and Bank of America, securing preferred shares that paid 10% dividends plus warrants, terms that virtually guaranteed massive returns. He recognizes the pattern. He has lived through multiple cycles, and he is positioning himself for the greatest opportunity of his lifetime. But Buffett is not acting alone. Private equity firms have amassed $2.5 trillion in dry powder. That is capital that has been committed but not yet deployed. They are holding it, waiting. They have been fundraising aggressively for 3 years, yet their spending has slowed to a crawl. Why raise capital if you aren't investing it? Because they are waiting for asset prices to disintegrate. They intend to purchase foreclosed properties, distressed businesses, and bankrupt corporations for 30 to 50 cents on the dollar. Meanwhile, corporate insiders are liquidating at levels not witnessed since 2007, just before the last crash. Jeff Bezos offloaded $13 billion in Amazon stock. Mark Zuckerberg sold billions in MetaShares. Jamie Dimon, CEO of JP Morgan, sold stock for the first time in his entire tenure. These individuals have access to real-time earnings data, actual financial conditions, and structural problems before they become public knowledge. They see the storm on the horizon, and they are moving to cash. This is the smart money, the institutional capital, the billionaire class, all moving in unison, exiting assets, building liquidity, and preparing. In stark contrast, the average American, the middle class, is more exposed now than at any point in history. Total household debt has just breached $40 trillion. Credit card debt is at record highs, auto loans are at record highs, student loans are crushing an entire demographic. Mortgage debt has returned to 2008 levels despite significantly higher interest rates. The middle class is all in. They are fully invested in stocks purchased near all-time highs. They are fully leveraged in real estate bought at peak pricing. Maximum exposure, zero cash buffer, no protection. This situation is by design. It is not necessarily born of malice, but of how the system is structured. The middle class is conditioned to remain fully invested at all times. Buy and hold. Don't try to time the market. Dollar cost average. Stay the course. Financial advisors earn fees based on assets under management. They want you fully invested. Real estate agents earn commissions on transactions. They want you buying homes. The financial media churns out stories about the fear of missing out, about people striking it rich, about buying the dip. Everyone amplifies the same narrative. Stay invested, buy more, do not hold cash. Consequently, the middle class does exactly that. They buy at the peak, hold through the crash, are forced to sell at the bottom, lock in their losses, and transfer their wealth to those who were waiting to buy. This has occurred in every major crisis, and it is about to happen again. However, this time, the scale will be unprecedented. Let's look at the 2026 trigger points. Let me explain why 2026 is the specific target, why the reset is arriving in the next 12 to 18 months, There are multiple converging crises. Any single one could be the catalyst, but together they generate a perfect storm. First, the commercial real estate collapse. $2 trillion in commercial real estate mortgages are set to mature in 2025 and 2026. These properties were financed when interest rates were at 3%. Now they must refinance at 8% to 9%. The mathematics simply do not work. The cash flows cannot support the increased debt service. 40% of these properties will not be able to refinance. That represents $800 billion in defaults. Owners are already walking away. Brookfield Asset Management, one of the largest real estate firms on the planet, defaulted on 2 Los Angeles office towers valued at over $1 billion. They simply handed the keys back to the lenders and walked away. If a giant like Brookfield is walking away, imagine what is happening with smaller owners. Office occupancy remains below pre-pandemic levels. Remote work has permanently slashed demand. Companies require less square footage. Vacancy rates are climbing. Rental income is plummeting while debt payments are skyrocketing. It is a death spiral. When these defaults cascade through 2025 and 2026, they will slam into the regional banks that hold these mortgages, and regional banks are already incredibly fragile. We saw the regional banking crisis when Silicon Valley Bank collapsed in March 2023. It was the second largest bank failure in U.S. history. Signature Bank failed that same week. First Republic Bank failed 2 months later. New York Community Bank nearly collapsed in early 2024 and required a rescue. These failures occurred when unemployment was only 4%, when the economy was supposedly robust, and before a recession had even officially begun. Regional banks hold massive exposure to commercial real estate. When those mortgages default, the banks absorb the losses. If the losses exceed their capital reserves, the bank fails. The FDIC steps in, but the FDIC only has about $125 billion in its insurance fund. If dozens of regional banks fail simultaneously, the FDIC simply does not have the funds. Some depositors will take losses, triggering bank runs. More banks will fail. The crisis spirals out of control. Then there's the corporate debt time bomb. U.S. corporations hold over $10 trillion in debt. Much of this was issued when rates were near zero. Now it must be refinanced at 5% to 6%. Interest expenses are tripling for many firms. Profit margins are being crushed. Highly leveraged companies that were barely profitable at low rates are now unprofitable at high rates. They will default. Bankruptcies are already surging. Chapter 11 filings are up 40% from last year. And this is before the recession. When the recession hits and revenues decline, defaults will explode. High-yield corporate bonds, the risky debt issued by weaker companies, are starting to crack. Spreads are widening and prices are falling. This is an early warning signal. When spreads blow out, it means investors are pricing in a much higher risk of default, which always precedes a wave of bankruptcies. Consider the message from the yield curve. The yield curve inverted in 2022. That is when short-term interest rates rose above long-term rates. It normalized in 2024. This specific pattern has predicted every single recession since 1950, without exception. The lag time between normalization and recession is typically 12 to 24 months. We are at month 18 right now. History dictates that a recession is imminent. When the recession hits, unemployment spikes. In 2008, it went from 5% to 10%. In 2020, it spiked to 14% in 2 months. This time, given the amount of leverage in the system, unemployment could hit 12% to 15%. That translates to 7 or 8 million people losing their jobs. When people lose their jobs, they are forced to liquidate, sell stocks to pay bills, drain savings, tap retirement accounts early. This creates massive selling pressure. When markets are falling, this accelerates the crash. Valuations are at extremes. The Buffett indicator, which measures total stock market capitalization against GDP, sits at 185%. Buffett himself has stated that anything over 120% is dangerous. We are 65 points above the danger threshold. This is higher than in 2000 during the dot-com bubble and higher than in 2007 before the great financial crisis. Price-to-earnings ratios are in the 90th percentile historically. Stocks are priced for perfection. They are priced for continued growth, continued profit expansion, no recession, and no disruption. Yet, all recession indicators are flashing red. When reality fails to match expectations, valuations correct violently. A reversion to the historical mean would require a 40% decline from current levels. If we enter a recession, declines of 50% to 60% are possible. That is exactly what happened in 2000 and 2008. Here's how the mechanism works, what most people fail to understand. When the stock market crashes 50%, where does that wealth go? Most people believe it simply disappears, evaporating into thin air. Market cap goes from 50 trillion to 25 trillion. 25 trillion is just gone. But that isn't how it works. Wealth does not disappear, it transfers. Let me explain the mechanics. When you sell a stock, someone else buys it. If you sell in panic at a 50% loss, someone bought it at that price, you locked in a loss. They acquired an asset at a discount. If they hold it for 5 years and it recovers to previous highs, they have doubled their money. Your loss became their gain. Now scale this across millions of people. Millions of middle-class families selling stocks in panic during the crash, all of them locking in losses. And who was buying? The wealthy who built cash positions. Buffett with his $325 billion, private equity with their $2.5 trillion, hedge funds, and institutional capital. They are buying everything the middle class is selling. This is the transfer mechanism, wealth moving from forced sellers to positioned buyers. It isn't theft, it isn't illegal, it is simply how markets function. But the system is designed to compel the middle class to sell while enabling the wealthy to buy. Let me show you how this played out in previous crashes. Look at 2008, the blueprint. By 2006, the housing bubble had reached insane levels. Home prices had doubled in 5 years. Mortgage lenders were giving loans to anyone. No income verification, no down payment, adjustable rate mortgages with teaser rates that would triple after 2 years. The wealthy started exiting in 2006 and 2007. Hedge fund managers like John Paulson analyzed the mortgage data and realized it was garbage. Borrowers who could never afford payments once rates reset. So they sold properties, reduced stock positions, and moved to cash. But the middle class was told housing never goes down. Buy as much as you can. Use your home equity. Everyone pushed people to maximize debt. The middle class loaded up right at the peak. Then mortgages started defaulting. By 2008, the entire financial system was collapsing. Middle-class families with adjustable rate mortgages saw payments double or triple. A family paying $2,000 a month suddenly owed $5,000. They couldn't afford it. Foreclosure followed. They lost the house and all their equity. 7 years of payments gone. Credit destroyed for 7 years. And the stock market crashed. The S&P 500 fell from 2,500 to 666, a 57% decline. Middle-class families, watching their 401ks get cut in half, panicked and sold at the bottom. They locked in massive losses. Millions lost jobs. When you lose your job and you're leveraged, you're forced to liquidate, sell stocks to pay bills, tap the 401k early, burn through savings. This is forced liquidation. But the wealthy had cash. Buffett bought Goldman Sachs and Bank of America when nobody else would. Private equity firms bought entire portfolios of foreclosed homes. Blackstone bought 40,000 houses at auctions for 30 to 50 cents on the dollar. Houses families had paid $300,000 for, bought for $150,000. Then the Federal Reserve intervened, dropped rates to zero, and printed $4 trillion. That money flowed into assets. Stocks recovered, real estate recovered. By 2013, we were back to all-time highs, but the middle class that sold at the bottom missed the recovery. They had no capital left. The homes they lost became rental properties owned by private equity. Rents were higher than their old mortgage payments. They became permanent renters in homes they used to own. $16 trillion transferred from the bottom, 90% to the top 1% in that single crisis. Then came 2020, the acceleration. In March 2020, COVID hit. Markets crashed 35% in 3 weeks, the fastest collapse in history. 22 million Americans lost jobs in 2 months. Small businesses shut down, 60% never reopened. The middle class faced an immediate crisis. No income, but bills were still due. They liquidated, sold stocks to generate cash, drained savings, forced liquidation at scale. But billionaires added $5.5 trillion to their net worth in 2020 alone. Jeff Bezos gained $70 billion. Elon Musk gained $140 billion, not because they created that much value, but because the wealth transfer mechanism activated. The Fed printed $6 trillion. That money flowed into asset prices. Stocks recovered the entire loss in 4 months. By August 2020, markets were back to all-time highs during a pandemic, during lockdowns, during mass unemployment. Why? Because the Fed printed $6 trillion and funneled it into asset prices. But the middle class that sold in March missed the entire recovery. They sat in cash, scared, unemployed, watching billionaires get richer while they got poorer. $5.5 trillion transferred in 1 year, the fastest wealth concentration in modern history. Every crisis follows the same pattern, 5 distinct phases. This isn't random. This is how the system works. Phase 1, the bubble. The Federal Reserve creates easy money conditions. Interest rates drop, money is cheap to borrow, credit is easy. This inflates asset prices. Stocks rise year after year. Real estate rises. Everyone feels wealthy on paper. The middle class is told this is the time to invest. Buy stocks. Buy real estate. Don't miss out. Financial advisors say, be fully invested. The media runs stories about people getting rich. The middle class loads up, buys stocks at all-time highs, buys houses at peak prices with maximum mortgages. All in, fully invested. right at the top. Meanwhile, the wealthy exit. They see valuations are extreme. They know every bubble bursts, so they sell systematically. Buffett builds cash. Corporate insiders sell at record levels. Smart money exits while the middle class buys. Phase 2, the tightening. The Fed raises interest rates. Money becomes expensive. Debt becomes burdensome. Asset prices stop rising. Cracks appear. But the middle class doesn't see the danger. They are told it's a healthy correction. Buy the dip. They stay fully invested. The wealthy aren't buying dips. They are building short positions, put options, positioning to profit. Phase 3, the crash. Something breaks, a bank fails, a company goes bankrupt. The trigger doesn't matter, the system is over-leveraged. When the trigger hits, it cascades. Markets crash 30%, 40%, 50%. Credit freezes, banks stop lending. Forced liquidation begins. Middle-class families get margin calls, must deposit cash, or brokers sell their stocks. Most don't have cash. Forced liquidation. Families lose jobs, can't make mortgage payments. Foreclosure. Forced liquidation. Families watching portfolios collapse 50% panic. Sell everything to stop the bleeding. Forced liquidation. At every level, the middle class is forced to sell at the worst prices. Phase 4, the transfer. The middle class is selling everything. The wealthy are buying everything. Foreclosed homes at 30% to 50% discounts. Stocks at half price. Distressed businesses for pennies on the dollar. This is the transfer. Wealth moving from forced sellers to buyers with capital. Every asset the middle class liquidated, the wealthy accumulate at generational low prices. Phase 5, the recovery. The Federal Reserve intervenes, always. Rates drop to zero. Money printing begins. Trillions flood the system. Money flows into asset prices. Stocks recover. Real estate recovers. Assets return to normal valuations. The wealthy who bought at the bottom have doubled or tripled their investments. They are massively richer than before the crisis. But the middle class that sold at the bottom missed the recovery. The wealth that transferred never comes back. The gap between rich and poor is wider than ever. Why will 2026 be different? Every previous crash followed this pattern, but 2026 will be different in scale. This will be the largest wealth transfer in human history. Here is why. The amount of debt in the system is unprecedented. Total global debt is over $300 trillion. U.S. debt alone is $35 trillion. Household debt is $40 trillion. Corporate debt is $10 trillion. The system is more leveraged than ever before. When highly leveraged systems crash, the crashes are more violent. The forced liquidation is more extreme. The wealth transfer is more massive. The middle class holds $50 trillion in stock wealth. When markets crash 50% to 60%, that is $25 to $30 trillion. But it doesn't disappear. It transfers to those positioned to buy. The wealthy are more positioned than ever before. Buffett's $325 billion private equities, $2.5 trillion hedge funds with massive short positions. They will profit on the way down, then buy on the way up. Double the profit. The Fed will print more money than ever before. In 2008, they printed $4 trillion. In 2020, they printed $6 trillion. In 2026, they will print $10 to $20 trillion. Because the system is bigger, the crash is bigger. The intervention needs to be bigger. The money will flow into assets the wealthy bought at the bottom, reflating prices, making them massively richer, while the middle class that sold misses the recovery. We are talking about a $50 trillion wealth transfer from the middle class to the ultra-wealthy in 18 to 24 months. The biggest concentration of wealth in human history. Now, here's the critical question. Will you be a forced seller or a positioned buyer? Will you transfer your wealth or accumulate wealth? The answer depends on what you do right now before the crash. Positioning matters more than anything else. First, hold cash. I know this goes against everything you have been told, but you need 20% to 30% of your portfolio in cash or treasury bills right now. Yes, you might miss some gains if markets rise over the next 6 months, but when the crash comes, you have capital. Capital during a crash is power. Buying assets at 50% discounts generates far more wealth than holding stocks down 50% with no capital at the bottom. When everyone is forced to sell, you are the buyer. That is how you switch sides. Second, buy protection. Put options on the SPY expiring 6 to 12 months out. Strike prices 10% to 20% below current levels. This costs 1% to 3% of your portfolio. If markets crash 50%, those puts return 5 to 10 times what you paid. If markets don't crash, you lose the premium. That is insurance. Bill Ackman turned $27 million into $2.6 billion in March 2020 with this exact strategy. Those profits funded buying at the bottom. Third, have a buy list ready. When the crash comes, when everyone is terrified and selling, you need to know what to buy. Quality companies with strong balance sheets, low debt, essential products, and competitive advantages. Apple, Microsoft, Google, Johnson & Johnson. Procter & Gamble, Visa, companies that will survive and thrive long term. Buy them at fire sale prices. You don't need to catch the exact bottom. Nobody can. But when stocks are down 50% to 60% and fear is at its maximum, start buying. Scale in over weeks and months. That is phase 4. That is when wealth transfers. If you have cash, if protection paid off, if you have the psychological fortitude to buy when everyone else is selling in terror, you position yourself on the other side of the transfer. You become the buyer instead of the forced seller. The choice is yours. The pattern is clear. The mechanism is documented. It has happened in every major crash, 1929, 1987, 2008, 2020. And it is happening again right now. The wealthy have exited. $325 billion in Buffett cash. $2.5 trillion in private equity dry powder. Record insider selling? They are positioned. The middle class is fully invested. $40 trillion in debt, all in at the peak. Maximum exposure. $50 trillion is about to transfer from forced sellers to positioned buyers. The largest wealth transfer in history. The question isn't whether it will happen. History says it will. The question is, will you recognize it? Will you position differently than the masses? Or will you be one of millions who lose everything, forced to sell at the bottom, transferring wealth to someone who saw it coming and was ready? The system isn't designed for you. It is designed to extract from you during every crisis. But knowing that, seeing the pattern and understanding the mechanism gives you a chance to avoid being the target, maybe even position on the other side. The transfer is coming. The only question is which side you will be on. 2026 isn't just another year. It is the inflection point, the reset, the largest redistribution of wealth in modern history. And you have maybe 12 to 18 months to position yourself. The choice is yours.